Okay, welcome back. Canfin Homes is the next company that we want to talk about. They reported a mixed set of first quarter numbers. Profit after tax has jumped about 11.5%, while net interest margins have declined. Disbursements have remained weak as well. Let's talk about this in some detail. Suresh Iyer is Managing Director and CEO at Canfin Homes. He's with us. Suresh, great to have you with us on the program once again. Good morning, Prashant this side. Let's just talk about margins. Your cost of borrowing is down, spreads have increased, but NIMs are down. Can you just sort of start there to kick this conversation off, and then we'll get into details?
See, in the Q4, of course, it was slightly elevated at 3.82. But compared to Q1 of last year, the net interest margin is higher. In fact, it was 3.57. It has increased to 3.6 plus. So 3.64. So in terms of the NIM, compared to the quarter, it has improved, and the spread has also improved. So that's the situation. Q4, we generally have, in the net interest margin improves because we also have reversals of the provisioning and everything. So that's the reason.
Where are NIMs headed directionally, Suresh, if you can give us a sense? Rates are down, and that should perhaps put further pressure?
Not exactly, because we generally see that we have a spread target where we try to keep it at 2.5% plus. And generally, we pass on to the customers after we experience it on our liability side. So basically, we are able to manage in terms of our spreads and everything. And therefore, the NIMs also, we have quite a bit of a control in that.
So your guidance was 3.5%, Suresh. Right. So should we work with that?
We are quite confident. 3.5% NIMs and 2.5% plus spread is what we are confident we will be able to maintain.
Okay, got it. Hi, Mr. Iyer. Good morning. Good to see you again. So we've got that out of the way in terms of NIMs. Let's focus on growth. Earlier you were guiding for a 15% growth, I think, in AUM. Do you think it's going to be a tall ask for the year? Do you stick to that guidance, 15% AUM growth? And also in dispersals, it was a little bit disappointing at around that 2,000 crores ballpark for the quarter. I think earlier you were guiding for roughly around 12,000 crores for the year. Do you think that's on AUM and disbursements? Please go ahead.
We had actually guided for 10,500 to 11,000 crore as a disbursement target for the year. And consequently, that would result in about 13% of AUM growth. Because we normally have about 5,000 crores, which is the rundown because of our prepayments, part prepayments, BT outs, and amortization. So keeping that in mind, we had about this. And incidentally, this is the first time in the history of Canfin that we have actually crossed a 2,000 number in terms of the first quarter disbursement number. And that's the one thing. In terms, if I break it up into our performance zone-wise, then our North Zone, West Zone, Tamil Nadu, which were performing last year, have continued their performance in this quarter as well. Additionally, East Zone, which is Andhra Pradesh and entire Eastern belt, they have also, which was flat last year, has also in Q1 shown an impressive growth. What remains is our main market, which is Karnataka, where in fact the state government has now taken some steps to ease out the e-Khata pressure. So we are hopeful that going forward, we'll be doing well there also. And in fact, what we have done in this quarter also in Karnataka has been roughly in the range of about 200 odd crores for disbursement. So it's not very off from what we have been looking at. And once the e-Khata issues are resolved, we should be able to see a good push coming from Karnataka as well.
Okay. So, Mr. Iyer, that means you're sticking to your guidance of 20% growth? Loan book growth?
No, we are not talking about 13% AUM growth. 13%, which we are sticking to because 10,500 crores is what we will be looking at.
Okay, so 13% AUM growth. And what are the plans for branch expansion to fuel this growth?
So actually, there are two things mainly which we are looking at. One is we have about 15 additional branches we are looking at. And the last couple of years, we have opened 29 branches. And this year also, we are targeting 15 additional branches. And mostly this will be in the west and the north. And additionally, what we have done is last year we had started with a sales team, dedicated sales team, which was contributing about 4%. This year we are increasing the strength of the sales team. And from 37, 39 people who were there in the sales team, now we have from 1st July, we increased the staff to 100 people. So that is also a good jump that we are seeing. And we should be able to now improve the performance coming from the direct business from the sales team. Incidentally, the sales team contribution in Q1 has been has increased from 4% to 5%. So that also it shows that the sales team experiment and the experience that we are having is quite good.
What does it mean, sir, in terms of cost-to-income ratio?
Cost-to-income ratio, we are targeting about 18%, 17 to 18%. Around this quarter, it is a little higher because in the first
18.3%, so it stabilizes at 17 to 18%.
18%, about 18%, because we have had the increase in our salary and everything for the staff, because we had a benchmarking the competition and everything. So because of that, there's also an actuarial implication which has come, which is entirely in the first quarter, which in the coming quarters will probably even out a little bit.
All right. Where are the return ratios headed? The ROA is around 2.2% and ROEs is ballpark around 17%. Where do you see these numbers stabilize at?
ROA, we are, we will be able to maintain 2.15, 2.2%. That's the thing that we are looking at. That should be maintained. ROE also around 17%. Of course, this time the costs have been slightly elevated. But going forward with our provisioning also, which will kind of reverse a little bit, and also the, evening out of the expenses, I think that also would be around 17%.
Okay. All right, Mr. Iyer, we'll leave it on that note then. Thank you very much for joining in. Good to get that perspective from you on the business. That's Canfin Homes. By the way, let's quickly go back to the market.